Yes, I'm Pearl. I'm one of the co-founders of Snowball Wealth. As a quick background, Snowball Wealth, we help people manage student debt so that they can really achieve other financial goals like investing or really starting to build wealth. As quick background, I'm also a fellow UCLA graduate, so go UCs, a native of the Bay Area. I'm a first generation as well, so I was the first to go to college, and also my mom, she was a single parent mom who really raised me through college. So definitely empathize with a lot of sort of the biggest financial priorities that a lot of people have when they graduate. And excited to see too, a lot of people from lots of different places. It sounds like people are scattered about across California during COVID-19. So thank you for joining for all across. So, we have about up till 6 p.m. So, I'll try to get through as much material as I can. Everything here is really informational. I'm not a, certified financial planner, so not really giving you specific advice like that, but really giving you a foundation for how to put your finances together and, sort of be ready when you graduate. So yeah, first off, really wanted to learn about everyone here today. Since the presentation is recorded, I thought it wasn't as appropriate for people to share their personal finances, but at least we can get a general sense based on the question poll. So I'm going to end the poll now. Yeah, so it looks like, of everyone, can people see the poll on your end? You do not see. Okay, okay, do you see it now? Hopefully you see it. Perfect. Yes, so, looks like one of the biggest priorities of this group is helping your family. So that's really huge. And then secondly, building your savings, followed by both learning to invest and buying a home, which I think is great, because those are steps towards building the wealth. And then finally, building up your credit score. Okay. So yes, I'll try to address all of those during this presentation, but if not, we can follow up at the end, and feel free to ask questions. So yeah, as I mentioned, the topics I'm really going to cover are Personal Finance 101, how to adjust during COVID-19, and then Q&A at the end. So, for Personal Finance 101, what topics do we really care about? Like I've laid them out here. I really want to think about what is an emergency savings and how to save for it, how to start budgeting when you graduate, what a credit score means, and how to start building up a credit score, the different types of debt, including personal debt and student debt, and thinking about investing in retirement, which is something that you're not too young to start. You can start immediately after you graduate. So, what really is the key to personal finance success? The first step you need to do is really start having an emergency savings account. It sounds like a lot of people, that was the top of things on their mind. What does an emergency fund mean? It means, ideally like a minimum of 3 months of living expenses in cash. And obviously this is based on, how much you spend per month. Emergency fund is only money when you need it. So, it's not overspending during the holidays. It's not, ideally a family member who just needs some extra cash. It's really like money for you, when your car breaks down or something happens. I think another thing about emergency fund is to make sure that you're earning money on it. A lot of people, they'll have this huge savings, but then it's earning 0% interest on their money, which means it doesn't grow at all. So that's, the third thing I would really recommend. And the way you can do that is you can put it into a savings account where there's some interest, whether it's 1%, 2%, just something where at least it's growing. The second step really to your personal finances is, to spend less than you make. This seems like a really simple idea because like it seems very simple, but a lot of people actually don't follow it. And it's hard to tell sometimes when you're first out of college because you have so many expenses that are going on. um, but what you can do is, if you spend less than you make, you'll always have a little bit of a buffer, so you can start either paying that debt with that money or investing that money, or putting into retirement. But that's a pretty like simple equation that you can hold towards. And, I think another thing, specifically to your emergency savings or even to, starting investing or retirement is like, no matter what, try to pay yourself first. We usually recommend a rule of thumb of saving from 10 to 15% of your paycheck. And every percentage above that matters a lot. So, that's something I would encourage everyone to think about. Especially if you're in a first generation family. A lot of times, I would say you have family obligations, like you're sort of the last in line all the time. But paying yourself first is really important, and that's starting off with your emergency fund and your savings. And a good way to do this too is to make sure you automate it, so that you don't even need to think about it. When I first graduated, I immediately just sweeped, I would say like $100 per paycheck into a savings account, and it wasn't much at the time, but it definitely adds up, and it's sort of like a snowball effect where the more money, the more times you save, the more you have at the end. So next, I'm really going to go through budgeting, since we've covered the emergency savings. Uh, can you talk to the panel about like how many people already are budgeting? Okay. Okay, perfect. So, some people are starting to budget. Um, yeah, if you haven't already, it's never too late to start. Budgeting is really a great way to understand where your finances are going. Everyone has a really different style. Some people have an Excel spreadsheet. They like categorize every single thing that comes in and out. And then some people, it's like it's more buckets. There's no right or wrong way. It's really the way that helps you get to your financial goals. For example, I'm someone who, it's really hard for me to track every single expense, but as long as I know, I'm spending this amount in, shopping, this amount in food, like that will help. So yeah, so there's usually, I think there's a difference between really like the needs and wants. Needs are really the things that will keep a roof over your head. For example, your rent, your utilities bills, all of that. And then wants are sort of like any other consumption that you have, which you don't necessarily need. Um, and then the third bucket is really savings and debt. Um, and savings and debt, I mean, there is, that percentage that you'll go towards paying down your debt, building your emergency fund, or saving for long-term goals, whether it's investing or retirement. So we usually like to go by the 50-30-20 rule. This is one way to budget. It's not, the way that everyone has, but where your, needs, you'll have that percentage of the 50, the wants 30, and the savings and debt 20%. And when people budget, a lot of times they'll break it down by spending category. And happy to follow up at the end, if people do want a budgeting template or sort of the categories to go with. Um, and I think especially for a lot of you in the audience, you haven't graduated yet, and I'm sure when you first graduate, your first 3 to 6 months will be really bumpy, just because you're moving somewhere new. You don't know exactly how much you're spending on food because you might be living independently. So it usually takes about a few months to get an accurate picture of how much you're spending month to month, and after that, you can really start to create a budget, that you can have like every single month and be consistent. And the last thing I would recommend about a budget is, don't forget annual expenses. Sometimes those can come out of nowhere. Annual expenses like car insurance, sometimes like health insurance, like large bills. Just make sure you also account for those in your budget. Next topic I want to talk about is credit scores. So, how many people are actively tracking their credit scores? Raise your hand if you are. Okay, that's amazing. So, yeah, it sounds like a lot of you are doing that. If you aren't actively tracking your credit score, I recommend you start doing it ASAP. It's never too late to start building up your credit. The way you can do those, you can get a free credit score on any of the banking websites usually, or you can go to a free service like creditkarma.com. Or you can get a free credit report every single year from the three credit bureau agencies. And I think the site is, I think it's free, or annualcreditreport.com, so I can send that afterwards. But yeah, find out what your credit score is first, and then find out what's on it. Ideally, make sure that everything on it is your account and not anyone else's. It's like it's not like your parents' account where they added you and they weren't supposed to. Just it's all your, like all of your things. Sometimes parents will add their children to their accounts, but you'll have to know that that they did that. So lenders, they'll report to three major credit agencies when you apply for debt, receive debt, pay debt, and the credit score is really important because when you apply for a rental application, when you try to get your first car, they'll run your credit report and understand, try to understand, like, do you have the ability to pay for this? So if you look on the right hand side, this is just a breakdown of the FICO score, which is one score, and you can see, the percentages of the different categories that they attribute the credit score to. So you hear it's 30% is, how much you owe, 15% is like the length of the credit history, 10% is how much credit you have, like what type of credit you have, and 35% is payment history. So yes, the aim is, obviously, like, to get your credit score above 800, but you definitely have to start somewhere. So if there's one thing that you do after this presentation, like, I would recommend just know what your credit score is and try to start building credit. So here are some not sort of quick ways that you can start building your credit score that we've laid out here. I think one is really to start to have a credit card and to charge a small amount to it. Um, to get added to your parents' credit card as an authorized user. That will help because your parents' credit will really boost yours. On your student loans and your auto loans, like when you start paying those straight out of college, have consistent payment and don't miss any payments. A way to do that is just to do auto payment. Another thing is, don't try not to pay interest. So what happens is on your credit, for example, your credit card, you can pay a minimum balance where you don't pay the full amount. It's usually recommended that if you can, you try not to hold a balance and pay interest every single month. Another thing is that you don't miss a payment ever, and try not to spend too much to hit your limit on your credit. Beyond that, also, a lot of places are starting to report uh, sort of your rent or your utility payments to your credit score, so you can take advantage of that in the future as well. So next off, I'm really going to go through debt. So how many people have, if you can raise your hand, if you have any personal debt? So that's credit card debt, like medical debt, tax debt. Okay, so a few of you. And how many people have or will have student debt when they graduate from school? Okay, so it sounds like people in this audience might not have too much student debt, which is great. So I'm just going to go over quickly these, and then we can definitely cover more later on. Yeah, um, so for debt, not all debt is the same. So when people say, like, oh, there's good debt, bad debt, like, a lot of times, it really depends on the debt, the amount, the interest rate. Like, so what I would look at is there's a chart on the right where there's different types of debt. I think one is credit card debt. In general, credit card debt usually is really high interest. It can be from 18% to 24%, but that adds up. There's personal loans, and personal loans can either be, just a loan for you to use, for something you want to do, or car debt, for example. And that can range, but personal loan of 10% is considered high. For student debt falls in different categories. Student debt can be as high as 10 to 12%, 7%, 2%. Student debt isn't good or bad. It just depends on the interest rate. There's a mortgage, which is used to buy a home. For that, that's historically mortgages have had lower interest rates. So here it's like 4.5%. So yeah, so it's really important to know, like, if you have debt, what type of interest rate do you have on that debt? Um, and obviously, when you look at someone's financial profile, the more debt they have, the more risky they seem. And that's because the more debt you have, the more you have to pay per month to pay off the debt. So it's usually good not to have too much debt. The other thing is, how many people are familiar with compounding? And raise your hand if you are. Okay, so it seems like a few of you are in the audience. Yeah, so for compounding, you know, that's a pretty important term where it can work both for you and against you. For example, if you have debt and you're paying a certain amount of interest, and the next month you don't cover that interest, and you're paying interest on interest. It just keeps growing and snowballing, where your debt can sort of multiply. Like in 2 years, your credit card debt could double, for example. And then compounding goes the other way, where when you invest money, as you make more money, you're making more money and more money. So it also snowballs where you end up getting a lot of money at the end. Um, so, in terms of debt, compounding is not your friend, which is why we always recommend, to be responsible of your debt and try to cover the interest every single month, and to not get into to debt that is very, very high interest. And paying down debt can improve savings rates over time. So that just means as you pay down debt, you can save more, invest more. So it's always good to try not to get into debt, but if you do have debt, to sort of like target paying that off. And for personal debt too, I know for a lot of you, especially first generation families, it might be hard to not get into personal debt, but I would say try to exhaust all options if you can, when you reach that decision to get into personal debt. Ways could be, if you want to buy a car, like maybe not buying the best car, not being like a 25K car, buying like a 15K car that's used. There's ways to be able to lower that, because once you have the debt, you're sort of stuck with that payment for a while. And for people with debt too, a lot of what people do is they optimize their debt, and what that usually means is they usually lower their interest through refinancing. So once you have debt, uh, as your financial profile gets stronger, so as you graduate, you get a job, you start making payments, your credit score will usually go up. Your debt to income will go up. Like, make sure that you have the best interest rate. So for some people, this might be a few years out, but yeah, it's good to have sort of a teaser about it. Yeah, so for student debt, it sounds like not as many of the audience have student debt. So I'm just going to go through this quickly, and happy to stop for questions if people have them. So for student debt, you start making payments 6 months after you graduate. Loans can be federal or private, and depending on this, you get different payment plans. Um, the longer you take to pay off your loan, the more interest you end up paying over the life of the loan. So it's important to think through that, because a lot of times people will sign up for a minimum payment. They think they're paying off their loans, but 5 years later, the balance is exactly the same, which happens a lot. And you can also look into lowering your interest through refinancing as well, as your financial profile gets stronger. And that's what we specialize at Snowball. So yeah, feel free to check us out. When that becomes an issue for you. Yeah, so you can see here, on Snowball's site, on the left, this is someone with 34,000 in student loans. And they actually have pretty high interest rates. They have an 11% and the 6.55%. So for them, it might make sense to lower it at some point in the future. And for them, based on how much they're paying per month, like $350, they're actually paying a lot in interest, like $228 in interest, versus a 122 in principal, which is why it's taking them 13 years to pay off their loans. So yeah, if anyone has debt, whether student debt or personal debt, it's really helpful to understand the interest rate and to understand how much you're paying on principal and interest, and how long it's going to take you to pay off your debt. Yeah, and these are quick recommendations. So I'm going to just skip this slide for now, since most people don't have student debt, but you can definitely check this out on the Snowball website, if you have student debt and you want to learn more. But this is just telling you what happens when you lower your interest, and what happens when you increase your payment on your student loans, which means you pay off your loans you know 5 years faster, I think, in this case. So yeah, so I wanted to pose a question to the audience. So the question is, will I have more money if I save when I'm 25 to 35, so for 10 years, or when I'm 35 to 65, 30 years? And this is saving the same amount of money. Okay, so we have one answer. Anyone else? Okay, perfect. So yeah, so I think you guys are right. This is awesome. So that you will actually make more money if you save when you're 25 to 35, um, in a over 10 years. So this is talking about compounding as well. And I think it's really the key to a lot of financial success, especially for a lot of wealthy individuals. Warren Buffett, one of the greatest investors of our time, is a huge proponent of it. The way he describes it is sort of like if you have a small snowball and you find a really long hill, if you just roll that snowball down the hill, I don't know if you notice the snowball gets bigger and bigger and bigger until the end where it's just humongous snowball. So that's the key where the earlier you start, the more compounding there is over longer periods of time. So it's beneficial for you to start early, even if it's a small amount. Um, here it's really saying usually, the money saved between ages 25 to 35, if it's the same amount, produces more money than all savings between 35 to 65. So here, the math at an 8% return, over 10 years, you're making 2 times your money, 20 years, almost 5 times, 30 years over 10 times, 40 years over 20 times, and 50 years over 47 times. So I think it just goes to show the multiplier effect where the earlier you start, the better. So I don't have a slide in here about this, but I wanted to make sure I did cover it. So how many people here are, would say, like going into their senior year or in their senior year of college? So, they'll have their first job soon. Okay, perfect. Yes, I would say, and for everyone else, it's good to remember this. You know, your first year out of college, you'll get a full-time job. They give you all of these benefits. One thing that I would highly recommend is for your retirement to really take a look at the options and try to understand. I think first off, if your company offers you any matching, what that means is, for matching is sometimes like if you put $1 into your retirement account, the company will also put $1 in. So basically, you're getting a free dollar for every dollar you put in. The reason why it's really good to take advantage of that is because you're basically like earning this return on your $1 just for being at that company. So, the earlier you put it in, like once you graduate, like that money will stay there and will be able to grow really quickly over, by the time you retire, which is usually 65. So that's the first thing I would look at when you look at your benefits. The second thing I would look at is the different types of retirement structures, because for a lot of people, when they first graduate of college, that's the first time that they'll be making money. It's usually a low enough amount where you can qualify for certain tax advantage retirement accounts, like a Roth account. So those are two things. We're happy to feel free to email me like once you get to that stage. But those are two things I would definitely look at. For me, when I graduated, like my parents had no idea what to do about any of this. So I sort of blindly followed my colleagues who had, rich parents who had financial planners who told them what to do. But in retrospect, I wish I had done all of this sooner because like that money that I put into the Roth has actually grown exponentially to today. So I can't even imagine like if I had put more money in the future, in the past. So perfect. And yeah, so this slide is really talking about market performance over time. I wanted to, I know for a lot of people, maybe actually, how many people are investing or have invested? And this includes just like buying a stock. Okay, perfect. So it's a good amount of you. Um, and yeah, so what I wanted to say is, obviously the markets have been going up and down recently. Like in March, it, fell tremendously. I think it was like 30%. And since then, it's also grown tremendously in certain sectors like tech. A lot of times people really get scared during these times and they'll pull out their money really quickly or they'll put in their money really quickly. So I think what this chart really demonstrates is that over, you know, a long period of time, the market will usually correct and, outperform. So, for example, if you were invested in 2007 or 2008 when that recession hit during then and you held your money till today, you would still be up a tremendous amount. So yeah, this is just to show, like especially for your retirement account, I would try not to, you know, be too scared about the market and pull out, pull in, too often, because that money, really is sitting there until you're 65. So it's really good to think long term about it. Um, and unless you're an active investor, which is obviously like a separate conversation, you know, for that, like it's definitely a different strategy for investing. So yeah, next off, I wanted to cover really COVID specific items. Um, yeah, maybe I can get a raise of hands of like how many people have been affected by COVID themselves or their families have been affected by COVID. Okay, so it seems like a good amount of people. I would say like a majority. Um, yeah, so I think for COVID, like I just want to really quickly cover these items in case people don't know about them. Obviously there was a stimulus check that was sent. I think post election, people are talking about potential another stimulus check. So I think that's something just to keep an eye on. For a lot of people, you can postpone certain bills, and I think this applies to both you as an individual and your family. But for example, car insurance, a lot of people have been getting rebates for that since people aren't driving cars. Health insurance, and people aren't going to do checkups too much. So to the extent like you can audit your finances to see what you're using and what you're not using, it's good to save some money on that. I think the third thing, which doesn't affect people yet, but student loans in general, all federally held loans, interest is 0% right now, and payments aren't starting until January 2021. So this could affect you if you graduate um, and the extension goes longer. I think another thing to think about too is, especially during this election, a lot of people have been talking about loan forgiveness for federal loans. So that's something also to keep an eye on if you have student debt, which Snowball can help you stay up to date on. I think the next thing is unemployment benefits. During COVID, there were a lot of unemployment benefits that were given. So, right now that has stopped, but in the future it might be offered again. So just to keep an eye on it. In general, people have also been building bigger emergency funds. The reason they have is, because of COVID, it might be harder to find a job. There might be more healthcare expenses. So, we usually say 3 to 6 months, but that could actually be a little bit more if you have the cushion for it. I think another thing is more people have also been investing in side hustles, and that's because especially during this tumultuous time, it's nice to have different income streams. Yeah, how many people have side hustles, or you're just like earning income off of something else? Okay, that's amazing. Can anyone share in the chat what side hustles they have? Just curious. Okay. Okay, that's great. So one of them is tutoring. Yeah. So I think the extent you have side hustles, like it's amazing, and it's a great way to build your emergency fund. It's a great way to start paying off debt. So the sooner you do it, the better. And yeah, and definitely like investing in stocks. Like that could be another side hustle. Side hustles come in lots of different ways. Like people always think it's sort of the starting a business on the side, but I think anyone can really venture into it with no capital. And the last thing I want to talk about is really protections. So for that one, especially for your family and for yourself, something to think about is just to make sure your family is protected, and that means ideally everyone in your family having some type of health insurance, even if it's like the really really basic kind. If you know like for some people like they might need life insurance, to think about that as well in case you have family members where like one family member is the one that provides income for everyone, but you're just worried that in any event might happen. Life insurance is good to look into. And yeah, I think just in general just helping to support your family as well, which let's see. Yeah, so I think that goes into the next slide. Um, how many people are currently helping to support their family while they're in college? Okay, so yeah, it's a good handful of you. So yeah, I think this slide I'll spend some time on it just because this also happened to me personally. I think for a lot of first generation college graduates specifically, there is this obligation to pay your family, or or especially in your culture, like that might be the tradition. So we've had a lot of our users where they graduate, they start paying their family $400 a month because it's sort of it's right. So I think for our advice really has been that it's obviously good to help your family, and a lot of times like they really do need to count on your help, but it's good to set boundaries to understand, because I think at the end of the day, as much as you want to help your family, you also want to help yourself. um, so I would recommend, like think of that amount where, you definitely feel okay of helping your family, which also allows you freedom to, invest in paying off your debt, uh, putting money into retirement, and possibly investing. And if you can't hit any of those three, then I would, really look at that amount that you're paying your family and see if like there's any way that you can do something else for your family. Yeah. And I think another thing I would think about too in terms of helping your family is and sometimes this one's actually really hard, is trying to understand like where the money goes. Like, because a lot of times you can help your family, but the money actually isn't going to a place that long term will help your family. So things that could help your family long term are more like instead of renting for the rest of your parents' lives, like being able to help them with a down payment, being able to help them with insurance, so that if anything happens, they won't be stuck with a $10,000 medical bill. So I would really press on that and try to think through what is the best way to help your family. Um, yeah, and I think especially for this group, like it's really interesting because obviously a lot of you could potentially be coming into more income than your parents have made in the past. I think that was for me. My mom, she I think her income was around like 20,000. When she was caring for me, and then my income was a lot higher than that when I graduated. So it's a really different experience. And I would recommend that in that sense, like you try to pay yourself first while helping your family, and that you also think about your finances in a way that might be different from how your family normally thinks of it. Especially for a lot of immigrant families, I would say the advice given might not be exactly appropriate for the amount of income that you're making, having graduated from a four-year university. Yeah, and then covering on that, like a lot of the things that I've encountered personally that I think might be helpful are, I think for a lot of first generation families, people tend to be less risk adverse. So that's speaking from my own experience. It might be different for a lot of other people. Um, so, because for example, for me, a lot of the advice I got was like, don't take on any debt. Any debt is bad, and that included a mortgage and a home. And I think actually, like a mortgage, if you do it the right way, it's a great way to be able to build equity in a home and to start building wealth. Yeah, for how many people does that resonate, or that's not an issue? Sort of like managing your finances differently from your parents. Like raise your hand if like you have different, I would say, like um mentalities on that. Okay, perfect. Okay, so it sounds like some of you that resonates. Yeah, and I'm gonna stop right now just because we're going into other content just to see if there's questions. Let me see really quick. Yeah, maybe you can raise your hand. For how many of you would this be helpful, this content? And if not, I can go to answering questions. Okay, so maybe I'll cover this really quick since we have a little bit of time. Yeah, so this one I covered. This is just really, for your first job, if employers offer retirement accounts, check if they offer matching, and if so, make sure you utilize it. See if you qualify for a Roth IRA. And what that means is you are putting in dollars that are taxed, so that when you take it out, you don't have to pay taxes on that amount that grows. So, make sure you look into that. And there's usually there's an income bracket for when you actually can qualify for Roth. So it's good to be able to put in money like while you can. And then make sure you know all your job benefits. A lot of times companies might not give it to you all in place, but just ask them during your first day of HR. What are all the benefits I could possibly get? Because that could be in healthcare dollars, retirement, and try to make sure you can utilize as many of them as you can. And yeah, for ways, so going a little bit into the job search piece, yeah, for how many people are you worried about the job search? Or yeah, okay. And how many people have jobs lined up already? Okay, some of you. So okay, so it sounds like it's a mix. Yeah. So I think for the job search, I would just make sure that you really narrow down your search. A lot of times people say, "Oh, I want to go into to finance," but then they don't really know, specifically like what industry, specifically in finance, what role, what size. I think a good way to do it is really to look at job specs and to see like is this the type of role I would want? Like, feel free to just like pull up LinkedIn or Indeed and look at the different jobs that are available on the site. And I think that will help you narrow it down a little bit of like, oh, like I would really do really well in this specific job, this specific job. And obviously, depending on the job market, like you might not get your ideal job, but I think at least you can narrow it down and then you can sort of like expand from there. Um, and when people ask you like, oh, what type of job do you want, like you can be very articulate about that and how you can add value in the specific roles that they do. Yeah, and I think the second thing I would recommend, which I am terrible at, but I think is really good for grads, is to really network. A good way to do that is to play the recent grad card. We had an intern recently who went to UVA, and she was able to network with a lot of UVA grads to land a full-time job. So feel free to just look at your online network, look at Berkeley, like I'm sure there's an alumni network, um, and see who is in your industry or the company or the role you want, and then just shoot them a quick note and say, like I'm a UC Berkeley grad. Or I'm currently in school, like I really admire blank blank. Like, would you be open to like a quick 15-minute chat just to share your experience? And more often than not, like a lot of people will say yes because they have an affinity towards the school they graduated from. And especially during COVID times, like a lot of people are on Zoom. A quick 15-minute chat like doesn't take that long for them to hop on a call. So definitely recommend you start doing that, and you can do that as of today, whether you're a sophomore, junior, senior. Um, you know that's like it's always a good time to be able to learn more. Um, yeah, and I think the get a referral that really applies to um, I think for jobs, especially in today's world, a lot of times people they go on LinkedIn, Indeed, and they just blindly send 100 applications out. It's a really good way to be able to get your resume on the top of the pile is to get a referral. And then the way you can get a referral is really through these, online chats where you tap into the online network, you talk to someone, and then maybe, down the line, you can ask them for a referral to the company. So I highly recommend that. I know it's hard for some people to ask for help, but more times than not, people who do get the job are emailing people, are having coffee chats, and are like asking for a referral for a job. So yeah, that's something where I would recommend versus blindly applying. And I think the last thing is really to build your digital brand. What that means is, if someone looks at your LinkedIn profile, like who do they see? Like what does this person like what is this person good at? What does this person do? Like how can they add value? Like what have they done in the past, like in all of their internships? So I would recommend investing in that. And beyond that too, like I'd also recommend, for your picture, depending on what type of job you're looking for, if it's, a professional job, try to have a professional photo up there. And today with your Apple iPhone, you can definitely do that. Or if it's like a creative job, like maybe you want a photo that's like a little bit more creative or a background image that's more creative. Perfect. Yeah, so I will stop there. It sounds like we covered a lot of ground, and I will stop share. So let me pull up some questions. Okay, so I will start answering these one by one right now. Yeah, so one question is, does it matter which bank you make a savings account at? Should be the same as the bank of your credit card. So yeah, so you definitely do not need to have a savings account at the same place you have your credit card. Um, what I would usually recommend is wherever you have a financial account, make sure that it's FDIC insured. And what that means is, if anything happens, like there's a run of the bank, like at least a certain amount of your money will be guaranteed by the government. So I usually like to go with a reputable bank just because I'm a little bit more cautious. But I think as long as the bank is FDIC insured, that's fine. And a lot of times for savings accounts, especially, like people will go to where the interest paid is the highest. So banks like Ally Bank, which are only online, those will usually pay higher savings rates. And yeah, so I think what ways can students generate passive incomes? Yeah, so that one's obviously a big question. And I think there's a lot of different ways. Like I wouldn't say I'm the expert on how to generate passive income. I have seen a lot of people where sort of content is important, where they have a perspective, they sort of write content over time, and they're able to slowly make money off of that. Um, so I would try to think, especially for a lot of students who might not have capital to be able to generate that passive income. Because if you think of someone who, has capital, a lot of times they generate passive income. It's through real estate investing, like, having a home, renting it out, and just having that flow. So I would try to think about like, what are ways I can utilize my skills where maybe I create something and then that will be able to still run on its own. Let's see. So another question is, how big of a snowball or initial investment do you suggest students start with when they begin investing? Yeah, so that's also a very big question. So I'm not a investment expert, so I want to make sure that you definitely seek investment advice from one. But I would say for investing, it's really dependent on how much you have and what your other financial priorities are. For example, if you don't have your emergency savings yet, I probably wouldn't make as big of an initial investment. If you still have debt that you're paying off, I wouldn't. If those two are taken care of, people usually recommend that like 10 to 20%, you're used to investing in yourself. And investing is also a loose term where that covers just investing in something that will grow in the future. So that could be your retirement or it could be a brokerage account. And are people familiar with the different types of investment here? You can raise your hand if you are. Okay, so it seems like not too many of you. Yeah, for investing, it's a term that's pretty broad, but there's different ways to invest. One is in your retirement, in which there's different vehicles, but for that, it's usually a little bit more rigid. But then there's also investing, just opening a brokerage account, and what that means is you're it's not tied to a retirement account, but just money that you're putting into an investment account. And for that, you can invest in individual stocks. You can invest in vehicles like ETFs, mutual funds, where it might be like baskets of things. There's also platforms where they do the investing for you. So yeah, there's a lot of different ways you can invest. So yeah, I think for this question, it's a little bit tough to answer how much you should um, start with for investing. But I would say, I'm of the mentality that like, even if you start out with like $20 or $50, you know, that's you're starting to invest, so it's not bad to put some money into the market. Let's see what else. Yeah, so if you get certain retirement benefits from your first job, does that stay with you when you switch companies? If they do, how do they roll over? Yeah, so usually when you go to your first job, you have a retirement account. Um, and you put money in, the company might put money in. The company sometimes has has terms where, if you stay at the company for 4 years, you get X amount vested. And what that means vested is that that's your money now. It's not the company's money. So they'll usually do a calculation to see how much money you have when you leave. And that money, that can either stay at where the money is for that job. So, it might be like a Fidelity is managing the money, or you can usually roll it over somewhere else. I usually recommend that, if you're at a company, that you roll it over to your own IRA. And the reason I do is so that you can be able to invest in more different types of investments. But yeah, that's something where, so it's definitely will port over to wherever you want to go next. Yeah, yeah, and I would say, yeah, Justin has a good point too. Like for people who want to maybe dabble investing, Robinhood is an interesting app that you can check out. What I would recommend for most people is that investing is obviously, it's its own big topic. As much as you can make money, you can also lose money. So I would say for investing, the way you should think about it is like gambling in a way where, if you put $20 in, like if you're willing to lose that $20, then I think that's fine. But if you're looking at it as, I'm making this return on this because Tesla has been going up like X amount, like I wouldn't make that decision. And yeah. Yeah, I think that is it unless other people have any more questions. See. Oh yeah, maybe that's the last question is what are some good books you'd recommend on these topics? Yeah, that one I'm happy to follow up with depending on the topic. I don't know if people on the chat they want to put in any books that they've come across. For me, I'm personally really interested in learning how people build wealth and investing. So some of the books I've read are like Warren Buffett. There's a book on his life called Snowball, which is pretty interesting. Learning how he thinks because he has a very different mind from a lot of people out there. So I would recommend checking that out if you're interested. There's, I think, Intelligent Investor is another book on investing. On personal finance specifically, though, I don't have one that I would highly recommend. So happy to dig up more on that. Yeah, I think. Okay, perfect. Yeah, so thank you so much, everyone, for joining. I really appreciated all of the sort of the interaction and sort of raising your hands, in this Zoom environment. And hopefully, you're able to learn and take away something from this. But yeah, feel free to email me if you have any questions at all. Like, always happy to chat. Always happy to support the UC community and especially first gen graduates. I was pretty clueless when I graduated from college, and I really wished I had, gotten the support I needed because I would have been much further ahead. So I really hope that all of you, you can take this advice, and 10 years from now, like I'm seeing you sort of generate wealth left and right. So thank you so much.